All right. So let's get started then with cash flows. Oh, let's do this. Okay, cool. So I put in some theory because I forgot to ask you whether you wanted to dive straight into the calculations or whether you wanted to start with the theory. But I think cash flow is very much a calculation-based kind of topic. I don't know what you think.
Yeah.
So just a brief background or reminder that remember the whole purpose of the cash flow statement is that it's part of the financial statements. So the way, a company would prepare the income statements, which is no longer called income statements, the statement of comprehensive income, the same way they would prepare the statement of financial position, then the statement of cash flow forms part of that. So that's what the whole purpose of it. It forms part of a company's financial statements. I'll send you the presentation, but just some theory that I put together, just because sometimes, with the grade 12 papers, they will always ask the theory question just in case,
Yeah.
So the purpose of doing the cash flow statements, you can just read some of those purposes, and then who are the users of financial statements. So just a bit of theory, and then just kind of like a summary so that you can see, the cash flow statements, the three main components, which is operating activities, investing and financial activities, and then what falls under that. But I truly believe that this should be studied after you've done various questions, because then it makes sense. But reading this now doesn't really make sense. It's just words, you know what I mean? But once you've practiced a few cash flow statements and then you come back to this, then it will make sense. Okay, operating activities, inflows, money received from sales, then it will make sense. Cool. But I'll send you this presentation just so that you have it, and you can just revise that, just for that 5-mark question or 8-mark question on theory for cash flows. So let's get started with today's. The information relates to red head. Let me just turn on my pen quickly. Okay, so the information relates to Red Head Motors. Red Head Motors is a listed company. We're not sure if that's going to make a difference in our lives. Probably not when it comes to cash flow. Authorized share capital is 5 million. All right, that's the authorized share capital. They import and sell automotive spares for all types of vehicles. The statement of comprehensive income statement for the year ended 28th of February 2021 revealed that a net profit after tax of 1505000, so 1.5 million, so just over 1.5 million was made. Okay, net profit after tax. Okay. Company is taxed at a rate of 30%. Okay. Then we're doing cash flows. So because we're doing cash flows, it makes sense that they will give us comparatives, right? So we do expect to see 2 financial years. And I'm not going to read this because it's not going to make any difference to you right now, because, it's just words and numbers. But you can see they've given you all the normal components of a statement of financial position. All right. What is retained income, all of that. Okay. So let's go on and see what comes next. Then they've given you the additional information, which, I always believe that when you are doing reading time, it is good to read all of this information because you're familiarizing yourself with it, which means that when you get required, your memory will be triggered and you'll remember, oh, I've seen this or I've seen that. All right.
Yes.
But for now, for the purposes of this, I'm not going to read it because there's no point, because you don't even know what's coming or what's been asked for you. So we'll go and visit it when we see the questions. Cool. All right.
Okay.
Then refer to the information relating to Red Head Motor Limited. The first one says, complete the following notes to the cash flow statement. Reconciliation between profit after tax and the cash generated from operations. So the cash generated from operations is money that came in, inflows and outflows during the normal operation of our business, right? Whereas profit before tax figure, it's more of an accounting figure. And why is this accounting figure? It's accounting because it will have non-cash items. Things that we just do for the purposes of accounting. For example, depreciation. You can't count depreciation. But it's more of an accounting thing. So you are reconciling between accounting and cash. So you need to remove things that are not cash. So we're going to start with our net profit before tax. So what is our net profit before tax? We're told that our net profit after tax was 1505000. All right. So let me just quickly see if we have any calculations. There's no space for calculations. Okay. So we'll just calculate on the side. So 1505000. And that was before tax, right? Then
Yes,
what do they tell you? They tell you your
after.
Sorry, that was after tax. We are going to before tax. So
Before
we need to go back. So what's the formula I should use?
Times it by what you want over what you have.
Good. What do you want?
We want before tax
100%.
which is 100.
Wonderful.
Over what we have is after tax, which is 130.
We have 130 before tax. You sure of that? Don't we have
over what we want? Wait.
Don't we have
no,
30?
what we want, which is 100 over what we have, which is after tax, which be 130.
Tax is 30. Okay, let's quickly talk about that. Before tax is 100. Tax is 30. After is 70. So this is what we have. This is what we want. Do you agree? Agreed?
Yeah, I get it.
So it's before is 100. Tax is, it's kind of like very similar to remember last week. The whole very similar. Cool. So do you agree it's over 70?
Yes.
Okay, let's calculate that quickly and see if we agree.
No. 215,000.
Okay, I agree with you. Now we need to adjust for what we said was non-cash, right? Things that would be in this figure that we need to take out because they are not cash. And part of that is depreciation, right? Because there would have been depreciation deducted from here that we would need to add back, all right? So let's calculate what's our depreciation for the year. We know that depreciation relates to fixed assets, correct? Right? When you're doing your PPE notes, do you agree that your PPE note would be what? It would be, let's go to our calculations. Your property, plant, and equipment notes, or what do you call it?
I don't know, PPE.
Okay, when you're doing your statement of financial position, your fixed asset notes. Fixed asset note. Okay, so that's the note I'm talking about. So the fixed asset note, my apologies. So your fixed asset note, right? We also call it property, plant, and equipment, which is the same thing as fixed assets, right? So your fixed asset note, do you agree with me that you would have said opening for any asset, whatever the asset would be opening, right? Opening balance. Then you would have additions, which would be things you bought.
Yes.
Right? Then it would be sold, things you sold at carrying value, right?
Yeah.
Then do you agree with me? It would be depreciation. And then do you agree with me? We would have at the end our closing balance. Correct? In this case, your opening balance, they told you over here that it is 1729 000. Okay, so let's go put that in. So opening 1729 000. Then our additions. Let's go read our additional information. Here is fixed assets. We're not going to read investments. We are here. New equipment was bought for 576,150 during the year. And an old delivery vehicle was sold at book value. So let's first deal with the additions. So we know over here we have additions and we also have a disposal, correct?
Yes.
Okay, so let's deal with our additions first. 576,150. So I'm going to go put that in under my additions. What did I say? 576? Is that 650, I think?
Yeah.
650. Ooh. Let me just quickly erase that. I put it on top of each other. Okay. 650? or 650? No, 150. So it's like 150. I'm just going to make that a 1. So 150, right?
Yeah.
Then let's deal with our disposals. We are told that a delivery vehicle was sold at book value. It has a cost price of 249 and an accumulated depreciation on or at the time of sale of 186,750. So what is our formula for book value? Book value is your cost price,
minus accumulated.
Minus accumulated depreciation equals book value. So in this case, our cost price is 249. Accumulated depreciation, very important. They were very generous to tell you that it was at the time of sale, because they could have given it to you at the beginning of the year and you would have gone and calculated the depreciation, right? But they were very generous. So do you agree with me? 249 minus 186,750, that our book value is 62250. And this book value also happens to be our selling price. Do you agree? Because we made no profit and no loss, because it was sold at book value. Agreed? So 62250, we are taking that to our fixed asset notes. All right. Whenever you sold something, it's out, so it's going to be in brackets, and we always put it in at book value, at carrying value, right? So we said it was 62. Oh, my memory is bad. Okay. We're relying on your memory. My memory is old. Okay. I have 3 kids. So 3 kids later, 3 kids later, I have no memory. So it's on you. You must remember things.
I'll try my best.
Then we need to calculate our depreciation. All right, for the year. Let's go and see what is our depreciation for the year. We don't know, right? Remember that that's what we're trying to calculate here. But what do we know? We know our closing value is 1931680. So 191931680. So do you agree with me that you can work backwards? You, the maths girl, work backwards for us and calculate what depreciation would be.
31680 plus 2250 minus 57650 7291. I got 688780.
For depreciation, I don't seem to agree. So let's do it together. Did you start did you start down and work your way up? 1931680.
Yes.
You changed the sign for sold. You added it.
Oh, okay. No, it is 680.
Okay.
Okay. Yeah.
Then did you
so
add?
I thought I added a number by mistake, but I didn't. It's fine.
Okay. So did you add 62250 opposite operation?
Yeah.
Did you minus? Okay. So did you minus 576150? And you minus 1729000.
Oh, that's a mistake. I missed out the one for the 7.
Oh, you did 79. Oh, I see. So do you agree now with this figure as our depreciation?
Yes.
Okay, so let's go put it in. So depreciation would be 311220. Okay, good? Done?
Yeah.
Okay, now let's go look at interest expense. Why is interest expense being adjusted for? It's not a cash, right? It's also an accounting calculation that we do. So we need to take it out as well. So what do we know about our interest in our loan? We know that we have a loan over here. The opening balance of that loan was 2016,000. We know that our closing balance was 2372,000, right? So you can clearly see that this loan increased. We took out more money, right?
Yes.
But that's not all we know. Remember, we're doing interest on loan. We also know over here that there was an accrued expense, interest on loan last year and this year. What is an accrued expense? It is an expense that is owing, right? So
Yeah.
at the year end, we owe it. We have not yet paid this expense.
Yes.
So it's a liability, right? So we know that we have that amount and we have that amount. All right. Then let's go and read our information with regards to interest. They say over here, interest is not capitalized. What does it mean when they say interest is not capitalized?
I've been taught this, but I can't remember.
Okay, so capitalized means you add it to the loan. So whatever the interest was last year, you add it to the loan in order to calculate the interest again. All right, so it is.
Oh, okay.
Whereas when it's not capitalized, you don't include it in the loan. So that's the difference, okay? Here they tell you interest paid during the year was 196,680. There's our interest paid during the year, right? 196,680. So let's go. 196,680. And that's our expense. But then we need to go and look at what we were told. We were told that the closing value was 18480, correct?
Yes.
And our opening was 17160. So do you agree with me? We are going to minus 18480 because it was last year's balance. And we're going to add this year 17160. What do you get as now your interest expense for the year, your actual expense?
9660. 17.
17. I'm not agreeing with you.
Wait, no, I'm sorry. I'm trying to figure out what the amount is there.
Oh, sorry, 17160. Sorry, very badly written. 17160.
Okay, I got 195,360.
Now I agree with you. 195,360. Please quickly add that for me to get what our profit before changes in working capital.
506580.
506580.
Yes.
I don't think I agree with you because this was 2 million. You left out this 2 probably because this was 2.1 million and this is 300. So it should be way more.
Oh, you're saying take the tax and then minus the 2?
Yes. Are we minus or are we adding? We adding, right? Oh, were you giving me the subtotal?
Yeah, I was.
Okay, my apologies. Give it to me. It is required.
580.
Like that?
Yes.
And now you can give me this. Let me erase what I had previously written.
I got 1643420.
Adding it. This plus this. Remember, depreciation would have been deducted in the income statement. So we're adding it back. Interest expense would have been deducted as well. So we're adding it back. We're doing the opposite, right?
I got 2656580.
2656580. I agree with you 100%. Now let's look at our changes in working capital. Let's first quickly discuss it. Do you agree with? Yeah.
Before you move on, I think I'm just a bit confused in terms of like the interest expense, like when you minus the 184, the accrued, and then you add the other accrued.
Okay. So this, the 17 is from this year. So let's just quickly go make note of that. So this is current year and this is prior year. Okay.
Yeah.
So an accrued expense is an expense that's owing. It's a liability, right?
Yeah.
So if you owed it, where would it be in terms of your T account?
If you owed it.
You agree with me? This is accrued expense. It's a liability, right? Do you agree with me that
Yes.
for the current year, we would credit 17160, and so therefore we debit 17160.
Yes.
All right.
Okay. Yeah.
Then, do you agree with me that the expense would be here?
Yes.
The current year expense. They said we paid it, right? Interest paid. So our bank would decrease 196,680. So our bank is credited. So debt is being debited. So no, I'm on the wrong side. Do you agree with me?
Mm-hmm.
Right? So there's our debit, there's our credit, right? There's our debit, there's our credit. Agreed?
Yes.
Do you need me to do it on a clean sheet or do you see it?
Can you please do it again?
Let's do it here. So last year we had accrued expense, which is a liability. There's our debit, there's our credit. Then we have interest expense, which is an expense. There's our debit, there's our credit. Fine. Now we're saying that in the current year, there's our liability, 17160. So we would be having accrued expense here, 17160, which is on the credit side, right? So that means over here it would be debited. But then they also told you over here that interest paid during the year, paid, right? So do you agree with me that if we paid it, our bank would be decreasing with 196,680, 196,680, which is a credit. So we would debit 196,680. Correct?
Yes.
Then your accrued expense last year, this one, 18480. Do you agree that that would be debited?
Yes, debited, yes.
What was it? 18480. And if that is the debit, we would credit it over here, right? 18480, if I'm correct. So if we balance our T account, let's quickly try and balance it. 17160 plus 196,680, if my figures are right. It is right, right?
Wait, am I supposed to add the two amounts?
Okay, which two amounts?
The 17 and the 196.
Yes. So this is the T account, right? So, sorry, I did it in the wrong place. That's why I'm doing it again. I did it here in the messy one. So what I'm saying is this was current year's liability. This is prior year liability, right?
Yes.
So you agree with me, the liability, if we debit it, we are going to credit it over here.
Yes.
So if we want to balance our account, how would we balance our account? We would add these two and minus that. So add these two for me, what do you get?
1716 plus 19660.
680.
Is that 6? Oh, 680.
Terrible, I know. It's this digital pen that makes my writing very dodge. I'm just going to erase it because it really looks dodge. You can't even see what it is. So it's 196,680. Yo, I tried my best, girl.
It's fine.
So what do you get?
The total is 213,840.
I agree with you, 213,840. So do you agree that if you minus that from 184?
84.
What is it even? 80, right? Do you get 195,360, right?
Yes.
And that is your interest. And that is what we're looking for over here.
Oh, okay.
195,360. So it looks weird when I just minus some plus, but the explanation of it is that, where are we? Is that an accrued expense is a liability. So current year would be on the plus side. For every credit, there must be a debit. There's its debit over there. Then our prior year wouldn't be increasing. It's from last year. So it would obviously, we're guessing we would pay it because we owed it. So that's why we are minusing it now, prior year. And for every debit, there's its credits. And then the current year, they told us we paid, our bank is decreasing, there's its credit, so there's its debit. Then we just balance our T account, and that gives us 195,360, which we take to our calculation over here.
Okay.
You sure you're fine?
Thank you.
Okay.
Yeah.
Remember that when you're doing the adjustments, they could also give you interest income, and you do exactly the same. Let's quickly talk about that. Honestly, I should always create an extra page for calculations. Oh, this is terrible. Okay, I'm just gonna write it somewhere here. I'm just gonna say here, interest income. What if it was interest income? Do you agree with me if it was interest income, it wouldn't be accrued expense, it would be accrued income?
Yes.
Because that is income that we owe. So how would we calculate it? We're gonna make up figures here. Accrued income is an asset, right? Not a liability. Do you agree with me that this year's balance would be on this side? Let's make it 200,000. Then do you agree with me? Last year's balance, let's say it's 195,860 would be on this side. But while we add that, we would have an account called interest income, which is the actual income account. Do you agree with me?
Yes.
There's our debit, there's our credit. There is current year. This is prior year. Current year, it's an income. It's not an income, it's an asset. It increases. So do you agree with me? For every debit, we would have a credit. So it would be sitting over here. Right? Then this one from prior year was a credit. So do you agree with me? It would be debited, 195,860. But then the information says for the current year, you paid interest income of, give me a figure. Should we make it, I don't know, 250,000? Sorry?
35,000.
35,000. So do you agree with me if we paid 335,000?
35.
35. So if we paid it, do you agree our bank would decrease?
Will go down, yes.
And so therefore there's the credit. So where's our debit? It would be here. Do you agree? Would balance this account, and I hope we haven't done ours badly because of the figures I made up. But you agree it would be 195,860 plus 35,000, which luckily we are more. So it would be 3,230,860. And then you would have minus 200,000. So do you agree with me? Your interest income would be 30860. We obviously made up the figures, but it's the principle that I want you to understand. And this is the adjustment that you would have gone to put in here. Here you would have interest income, the amount we've just calculated, and you agree with me, it would be in brackets.
In brackets, yes.
Because you're doing the opposite. In the income statement, it would have been added, so now you're going to deduct it. So it's very important that you use T accounts so that you see, now I can't remember where we did it, but it's important that you use T accounts so that you see what's happening and so that your signs are correct. Cool. All right. So are you good to move on?
Yes.
Okay. So now we're going to look at our changes in working capital. And I wanted you to just remember that with inventory, for example, do you agree with me that if our inventory increases, I just made notes for us here quickly. If we bought more, if our inventory increases, it means money went out.
Went out,
outflow. And if our inventory decreases, it means money didn't go out. So that would be an inflow. And then with our receivables, if our receivables decrease, it means people paid us. I'm gonna have to send you a new link. It means people paid us, right? So if our receivables decrease, people paid us, so that's an inflow. And if our receivables increase, it means people didn't pay us, so that is an outflow. Okay? Are you comfortable there? This inflow outflow thing always requires you to be in your, are you comfortable there? Am I losing you?
Yes, I am.
Okay, I thought I lost you, it froze.
I can still hear.
Okay, so now let's go and look at our information with regards
to everything's good.
Okay, let's go and look at our information with regards to inventory. Okay, so what have they given us with regards to inventory? So here we see inventory. They've given you your current year and your prior year is in a question mark. So we don't know. They don't tell us anything, right? Now let's go and see if there is anything they told us. Over here, they tell you the change in stock levels resulted in an outflow of 63,300. So what are they saying? Current year, prior year. Current year is 356,000, 356,000. Prior unknown, but they're saying this change resulted in an outflow of
outflow, meaning we bought more stock.
Wonderful, meaning we bought more stock. So it's in brackets, right? So then we can go and say, did it increase or decrease? It increased, right? Do you agree?
Yes.
What was the 63,300? Cool. Now let's go and look at our receivables. Let's quickly look at our receivables. What is happening with our receivables? Our receivables is what? Let's quickly look for it. There's our
inventory.
All right. So what do we know? We know that we have current year of 424,200. So let's go and put that in. So we have current year, we have prior year, we have 424,200. And what else do we have? We have prior year of 486,000. 486,000. So it's tempting to just want to go and calculate and say, oh, that's the difference. But what do we know? We know that we always have something else in the information below. A receivable, so we're looking for any kind of receivable. Do you spot any kind of receivable? Other than trade and other receivables?
No.
Okay. Do you agree with me that accrued income is a receivable? It's what is income?
Sorry.
It's income that's owing to you, right?
Yes.
So it's receivable as well. And it's 16,800 and 15,100. So let's go put that in. 16,800 and 15,100. So now you can calculate your new totals. Calculate prior year for us quickly. 486,000 plus 15,100. What do you get?
501,100.
Okay, current year?
42,4200 plus 16800. 441,000.
441,000. What happened? Did it increase or decrease?
Decrease.
And if our receivables decrease, what does that mean?
It's an inflow because they're paying us.
Wonderful. What's the movement?
Minus 441,3. 60,100.
60,100. And we said that it decreases, so it means Mula came in. So 60,100. And do you agree with me? We said it decreased.
Yes.
Okay, then let's quickly look at our payables before it kicks us out. All right, so our payables is here. Anything else we should take into account?
Accrued expense.
Accrued expense?
Yes.
Should we? Is it part of our working capital? We've already taken that into account in the changes before working capital. So do you agree with me? The only other, what is an accrued, what is payables? It's liabilities, right? So do you agree with me? The only other one is this. Because you agree with me that this one is actually income statement.
Yes, the income statement. Yes.
So we want this then because this is the only liabilities. And they're both credits. They're not debits. Be careful, if it was debits, we would have included it as part of trade and other receivables because it would have meant that SARS owes us. But if it's in credit, it means that we owe SARS, right? So let's quickly go put in our figures. It's 603,100. So current year and prior year, 603,100. And then it is 521,400. 521,400. And then what was SARS? SARS was 19,400 and 13,600. Okay, so 19,400 and 13,600. Can you give us our figures? What is our figure?
521,400 plus 1,360. 535,000.
Current year?
For prior year.
535,000. Okay, I'm with you. Current year?
03100 plus 19400. 622,500.
Movement?
5, 1, 2, 3. 87,500.
Increase or decrease?
Increase.
Meaning?
Increase in payables, like things we paying like. So increase means outflow.
If it was getting
outflow.
You said outflow. Okay.
Wait, no, it's inflow because we paying on thingy to our okay, yeah.
So which
Wait,
is?
if I'm paying my supplier, the amount goes up in terms of the credits. So that means okay, now I'm confusing myself.
If you're paying your suppliers, if your liability decreases, it means you are paying. If you are paying money,
yes, it means you're paying.
Mula is leaving your account because you're paying. That would be an outflow. So if your payables is going down, it means you're paying, which means you losing Mula, which means it's outflow. But in this case, it's not going down, it's going up, which means we ain't paying, which means inflow. We're losing money. So it's an inflow, right? So inflow of 8,500. You comfortable with that? So 8,500 inflow. Cool. All right, and we said it increased. Now you can calculate for us. What was our changes? These three.
63312 plus 60100 plus 8700. 84,300.
So it is 84,300. Awesome. And then our cash flow from operations, which would be these two.
265,6580.
Try and get through my Dodge writing.
I'm adding, correct?
Yes, you are adding because this gave us a total inflow.
274 0880.
Okay. Let's go and check ourselves. Keep that figure in your calculator while we just go confirm with the memo if they agree with us. 2740880.
Yes.
Okay,
correct.
They agree with us 100%. Well done. Good job. All right, so let's move on then to our next part. 3.2 is saying, calculate the amount of tax paid during the year as it would appear in the cash flow statement for the year ended 28th of February.